Welcome to Invest Education Hub. If you're looking to reach 2026 with a much stronger financial foundation, this explainer is for you. We're going to give you a complete plan that works whether you're just starting out or managing a larger portfolio.
And you're definitely going to want to stay until the end because we're breaking down 3 distinct levels of investment strategy. There's a clear path here for everyone, no matter your budget. Okay, so we're going to get into these 3 powerful strategies, one for each level you see here. But before we dive into the actual plans, we absolutely have to cover the single most important mindset for success. So many people, especially when they're new to this, get these 2 ideas confused. And honestly, understanding the difference is the first and most critical step to avoiding some major, really costly mistakes. This is such a common realization, right? It's that feeling when you're chasing some hot stock pick, hoping it's going to be your lottery ticket, but as so many people learn the hard way, that's not a strategy. It's a gamble. You're just betting on hope. So here's the bottom line. Investing is about steadily growing your money over a long period of time. Speculating, that's much closer to playing the lottery. It's super high risk, it's usually based on hype, and it is not a reliable way to build wealth. Our whole plan today is focused on real investing. All right, let's jump into our first level. This is perfect for anyone who's just starting out or maybe working with a smaller budget. The goal here is simple, but it's really powerful. Build safety first and then grow. Now, a core part of this plan is something called an index fund. This is an amazing tool because it means you don't have to worry about picking the next big winning company. Instead, you own a tiny piece of hundreds of top companies all at once. You get instant diversification. It's brilliant. The strategy for level 1 is built on a rock-solid foundation. First things first, you need an emergency fund for, life surprises. Then you build a base of low-risk stuff like treasury bills, with the rest of your money dedicated to steady, long-term growth through those index funds we just talked about. So here's what that looks like in the real world with a $5,000 portfolio. Notice how half of it is in super safe assets? That gives you stability. The other half is positioned for growth. It's a conservative portfolio, and it's designed for low volatility and steady compounding. With this kind of approach, you're not chasing some wild, get-rich-quick return. You're targeting a stable, realistic return with very minimal risk. You're just letting your financial foundation grow safely and consistently. Okay, so once you have that solid base and you're investing regularly, you can move up to level 2. The goal here shifts a little bit. We want to balance more growth potential with a still very strong defensive side. This level introduces some new things, like REITs. Think of it like this. You and a few thousand other people all pool your money together to buy a bunch of apartment buildings. Then you all get to share in the rental income, but you never have to be a landlord. It's a fantastic way to get into real estate. So here we're dialing up the growth potential a bit. We're putting more into stocks, diversifying outside the US, and adding real assets like REITs and gold. We even sprinkle in a small strategic bit of crypto, all while making sure we're using tax-advantaged accounts like a Roth IRA, so our money can grow tax-free. So as you can see, this portfolio is geared more towards growth. Over half is in stocks, but it's still balanced. It's got a big defensive component with bonds and gold to help cushion you against any market downturns. This balanced approach is all about aiming for higher potential returns by getting more exposure to market upswings, while still keeping a really close eye on managing risk. Now, for those of you with more significant capital and a long time horizon, Level 3 is where we really focus on optimizing returns through some pretty sophisticated diversification. This is where we get into some advanced strategies. We're talking about allocating to private markets, like investing in startups through venture capital funds, or even buying real estate directly. The goal here is to access returns that just aren't available in the public stock market. This chart really paints the picture of a highly diversified portfolio. Yeah, public stocks are still the core, but a huge chunk is now in alternatives, like private equity and real estate. It's designed to maximize long-term growth, and it's really for investors who can handle a bit more volatility. The goal here is pretty simple, the highest return potential of all 3 plans. But remember, this comes with a risk profile that is best suited for people with a long-term vision and the stomach to ride out the market's ups and downs. Okay, so you have the plans. Now for the warnings. Sticking to any of these strategies takes discipline, and these timeless rules, inspired by the legendary Charlie Munger, are the key to not messing it all up on your road to 2026. This first rule is maybe the most important one of all. Stop looking at what everyone else is doing. When you hear about someone's huge win on some random stock, it creates envy. And envy makes you do stupid things. It's absolute poison for your portfolio.
And the second rule is you have to accept that real successful investing can feel, well, kind of boring. The real money is made in the waiting, not in the frantic trading. It's about letting the magic of compounding do all the heavy lifting for you year after year.
And this is the key question you have to ask yourself as you build out your plan for 2026 and beyond. Your long-term success really truly depends on how you answer this. Are you an investor or are you a speculator?
Thanks for tuning in. If you found this plan helpful, do us a favor and hit that like button and subscribe to the Invest Education Hub channel for more clear, actionable financial strategies. We'll see you in the next one.